He's a guy that grew up poor, and he's now freaking out because he's got real wealth that he's never experienced before, and we just got to show him how to not pay income tax.
Wow.
So he came into 2023 trying to figure out, okay, what are we going to do this year so I can hardly pay income tax again?
You can make it so you don't have to pay any income tax. It's written in the tax code. It's legal. It's incentivized. And I did not know this. This is the podcast where my brother Bo Barron, CCIM, teaches me, Timmy Barron, ADHD, all things commercial real estate. Stick around to the end of every episode because Bo quizzes me on what I learned. Can you beat my score? I bet you can't. Commercial real estate like you've never enjoyed it before. This is Commercially Speaking. Why don't you teach me about taxes? Tax season is coming.
Yep. So tax season is can often be more complicated and much more rewarding if you own real estate. But there's really 4 reasons why somebody buys commercial real estate in the first place, or any kind of investment real estate. And there's appreciation, depreciation, cash flow, and equity. All right. So depreciate, or rather appreciation, is the idea that you buy something for X and you sell it for Y later on, and that Y is more. So you buy something for $1 million, you sell it for $1.5 million. 5-10 years later, it has appreciated in value. It's worth more. Pretty easy. Depreciation is a little bit weird, and it's unique to commercial real estate. And it says that I get to depreciate what I buy over a period of years. And if you bought $1 million property, you could depreciate that over 27.5 or 39 years. Now, here's what that means. Okay. If it's multifamily property or residential, you can depreciate it over 27.5 years. So you take what you bought it for minus the land value. You don't depreciate land. So you subtract out the land value, and whatever's left, you can depreciate that over 27.5 years. So let's say that comes out to, I don't know, $10,000 a year of depreciation, and you make $100,000 a year. It would reduce your taxable income from $100,000 to $90,000. So that depreciation is like a phantom expense that you don't have to pay that lowers your taxable income every year. So if you've ever heard somebody talk about commercial real estate as a tax shelter.
Never heard that.
Well, that's what they're talking about. It shelters some of your income by creating an expense that's on paper that you didn't actually have to lose dollar bills. Dollars didn't leave you, but you got to reduce your taxable income. That's what depreciation is.
Can I say that back to you? Because I'm a little confused.
Sure, go ahead.
You're subtracting the value of the land, because that does not depreciate, correct?
That's correct.
Does the land appreciate?
Yes.
Yes.
Okay. It can. It doesn't always.
In this situation, you, I guess, deduct the value of the land.
Right, so you buy a building.
You buy a building.
The building has a useful life. At some point in the future, that building's not going to be there. But the dirt underneath it, it will be here. You can depreciate a property, but not the land.
I mean, kind of like a car, right? A car is going to ultimately die. It's not going to keep running. When you're looking at what's the 27.5 years? Like that's the average life of a building?
No, it's like what the IRS says. It comes from the tax code.
Yeah.
Now, we talked about apartments, 27.5 years. Everything else, office building, industrial, retail, that's all 39 years. So $1 million, let's say the land value is $200,000. So you're able to depreciate $800,000 over 27.5 or 39 years. And you just take that number and you divide it by 27.5 or 39, and that's how much you can depreciate every year.
Depreciation, is that the same as a deductor? Like you deduct that?
So it's just like if my business made $100,000 and I spent $20,000 in expenses, my business would only pay tax on $80,000.
Right.
But I actually spent that money. With depreciation, you don't actually spend the money. The government is giving you all that money back over the life of that property. Why? Because they want you to buy it.
And why they want you to buy it? It's really linked to a capitalist idea that it trickles down.
Well, now you sound like Reagan, trickle down economics, but just think about it this way.
Okay, cool. Yeah.
When's the last time you got compared to a Republican president, little brother?
Never.
Yeah.
Only when I'm doing impressions. Yeah.
So think about it this way. I didn't build this building that I'm in right now, but I did buy it. But let's say I built it. There are 8 companies that exist in this building. They all employ people. They all generate revenue that is taxed.
Mm.
Every one of those employees lives somewhere.
Mm-hmm.
And the money that they make by working at the businesses that are domiciled in this building, you see how that multiplies out?
Yeah, I do. Yes.
So, man, they're going to incentivize development, investment, that kind of thing in property. It circulates dollar bills over and over and over again. And that helps everyone.
Right. That's what I meant. Thanks for putting that in.
Yeah. So it does. I mean, you could say, man, it kind of trickles down.
Right.
That's appreciation and depreciation. And then there is cash flow, just taking this building that I'm in that we've been talking about. The businesses that are the tenants in this building, they pay me rent, and that creates cash flow, which means I can create a podcast with my little brother because there's money for that. And I can employ people. So people invest in commercial real estate because it creates cash flow. And you want to kill a business? Deprive it of cash. That's what makes everything work. And then the last thing is equity. I have a loan on this building, so it's worth something, and I owe on it. And so I have a certain amount of equity in this building. But every time these tenants pay me rent, I turn around and pay my monthly mortgage on this building, and my equity increases. So on paper, I'm worth a little bit more every time I pay that mortgage down. Just like somebody who owns a house has a mortgage. Every time they make a mortgage payment, their personal wealth and equity increases just a little bit. When you own investment property, your tenants in reality are paying your mortgage for you. Those are essentially the 4 reasons why somebody invests in commercial real estate. Now, when it comes to tax season, here's what people who have commercial real estate, here's what they can do. And in fact, the tax code says they should do this. If you're on kind of the outside of the industry, I can see how people can look at this and say, this is a loophole.
Right.
But think about this. I have landscaping outside of this building. Did you hear that?
Yeah.
That like came from down here and kind of jumped up and wasn't really a burp, but it could have been.
Yeah.
I've been watching Last of Us, and now I'm a little worried about what might be inside of me. Holy moly. Think of my parking lot outside.
Okay.
Does that have the same useful life of the building? No. I got to reseal that thing every 5 years or so. The landscaping has a shorter useful life. The carpet inside the building, that has a shorter useful life. There are components of this building that have no business having a useful life of 39 years. So the government allows you to do a cost segregation study. So what you do is you grab an accountant or an engineer who knows how to do this. They come in and they, on paper, deconstruct your building, take all the components of your building, and they put them on different life cycles. I think there's a 5, 10, and a 15-year life cycle, and then there's the 39. This is a retail building, so it's 39 years. So what that means is, right now, if I don't do a cost segregation study, I take the value of the building minus the land, divided by 39, and that's what I get to depreciate every year. If I do the cost segregation study, then some of that value is going to be removed from the 39-year schedule and put on a 5-year schedule. So let's say $100,000 gets moved from 39 years to 5 years. Now all of a sudden, that $100,000 divided by 39 was going to be something small. $100,000 divided by 5, now I get to depreciate $20,000 a year. So after the cost segregation study, it moves a lot of that value onto these schedules that allow you to depreciate faster than the 39 years. I'm not getting to depreciate more than what I paid for the building, but I get to depreciate more of it up front. So let's say I made $100,000 in a year, and because of my commercial real estate investments and the cost segregation studies, I get to depreciate $95,000 in a year. My taxable income would be $5,000.
Wow. Wow.
So when you hear Trump say he paid no income tax, This is exactly how he did it.
Yeah.
He depreciated the commercial real estate investments. It's probably not the only way he did it, but it's legit. They want you to do it. And here's why they want you to do it. If I know what I think I'm going to make in 2023, I can actually do the math and see, what do I have to buy in commercial real estate to pay no income tax this year? I can do that math. And so conceivably, if you get a little taste of that, maybe I make a whole lot of money this year, but I've bought a certain amount of commercial real estate and I do a cost segregation study on it. I can reduce my taxes to the point where next year, well, I got to buy this much more again so that I pay more income tax. And now every year I go into it thinking, how can I not pay income tax? How much do I have to buy? Now, what you should be thinking right now is, well, where's all the money come from to buy this stuff in the first place? I'm not made of money. I can't just arbitrarily say, okay, I'm going to buy $10 million of commercial real estate this year. So the money that I borrow from the bank to buy something, I get to depreciate their dollars. So it's a big force multiplier. Now, every time you borrow money on a deal, it increases your risk in a big way. Well, getting back to cost segregation. Now, you're going to pay, I don't know, $7,500 for the study. So a lot of times, if the property's not worth at least $1 million, it doesn't make financial sense to do the cost segregation study. But something changed in 2017. They changed the tax law, and they allowed for this little funny thing called bonus depreciation. And here's what bonus depreciation was. Remember how I said in the cost segregation study, it moves value from that 39-year schedule to these 5, 10, and 15-year schedules?
Yes.
Well, the 39-year schedule, or the 27 and a half if it's an apartment complex, that's called the real property schedule. The 5, 10, and 15 years are called the personal property schedules. What the law did in 2017, it said, if you do a cost segregation study, and that value is moved from the real property of 39 or 27 and a half years to the personal property of 5, 10, and 15, you can bonus depreciate 100% of it in that year.
What does that mean?
It means you can take all that depreciation that moved from 39 years to 5, 10, or 50, you can take it all up front in that year. All of it. All of it. So you can wipe out a tremendous amount of income in that year.
Where's the limit? Like,
the limit is I can't wipe out more than I actually made that year. Let's say I made $100,000 in a year, and I bought a piece of property, and we did a cost seg study, and then we bonus depreciated all of it in 1 year. And let's say that created $300,000 of depreciation in that year.
right.
I can only wipe out $100,000 because that's all I made, but I can carry it forward.
Rollover minutes.
Yeah.
There it is.
Rollover minute. That's exactly what it is. It allows me to wipe out my next $200,000 worth of taxable income.
Wow.
So let me tell you a story that kind of puts all these together.
Yay, story time.
Story time. Buddy of mine sold an apartment complex, walked away with a $1.1 million gain. So he made $1.1 million. So he's going to get taxed on that $1.1 million unless within a period of 6 months and jumping through a couple other hoops,
He buys more property.
he bought more property with it. Okay. So I helped him buy 2 retail centers, one here in Owensboro and one outside of Huntsville, Alabama. He took that $1.1 million, he married it with some debt, and he bought close to $6 million worth of commercial real estate with it in those 2 centers. So he went up, he bought more. So he deferred what he would have owed in taxes into these other properties, doesn't have to pay them until he sells those properties, unless he does it again.
Mm-hmm.
You just keep kicking that can down the road by doing what's called 1031 Tax Deferred Exchanges. But he did a cost segregation study on both of these properties. And then with bonus depreciation, because they both happened in 2022, he was able to bonus depreciate everything that got moved, all the value that got moved from the 39-year schedule to the 5, 10, and 15-year schedule. He made around $700,000 last year, and he wiped out all of it but about $80,000.
Wow.
And he's a guy that grew up poor, and he's now freaking out because he's got real wealth that he's never experienced before, and we just got to show him how to not pay income tax.
Wow.
So he came into 2023 trying to figure out, okay, what are we going to do this year so I can hardly pay income tax again. But he's employing people. He's investing in real estate that is circulating all those dollars around and around again. You know what happens every time dollars are circulated? Taxes get paid. And so the government likes anything that'll circulate dollars throughout an economy.
Gotcha.
Now, the only other thing you need to know about bonus depreciation is it sunsets. From 2017 to 2022, you could bonus depreciate 100% of what a cost segregation study moved from real property to personal property schedules.
Mm-hmm.
In 2023, the year we're in now, you can only do 80%. But okay, that's still a great deal. Next year, 60%, 2025, 40%, 2026, 20%, 2027, bonus depreciation goes away. Unless they change the law again and extend it or whatever, who knows?
And so would you say that that was put into effect because...
Our president was a commercial real estate investor?
Well, no, that's not what I was going to say, but to help the economy.
Oh, yeah, it's a stimulant, and it incentivizes people to take risk on property.
Yeah, no, I mean, do you think that because Donald Trump is a commercial real estate investor, that is where, like, did bonus depreciation exist before 2017 at all?
It hasn't in the last 20 years I've been in the business. It might have been a new creation.
Mm-hmm.
And it probably happened because our president at the time was a commercial real estate guy.
It probably was able to move forward and actually get into place with the sunset limiter.
Yeah, I'd be interested to look back. Like, was that a condition of the left side of the aisle going along with it, or who knows?
That was. Yeah.
I wouldn't be surprised. Yeah.
Yeah. Because just thinking of Donald Trump, like, he would be like, yeah, no, we need this. And this is great. This is great. This is good. Brilliant. It's like, we need to put a limiter on it. Nope. Yep, we do. We're not going to do it. Okay.
Best idea ever.
Yes. Yeah. I'm the greatest. Okay.
That was pretty good.
Okay, that's bonus depreciation right there.
Now, there's one other thing you need to talk about and understand. When you talk about bonus depreciation, you can only wipe out passive income, not your active income. I don't even know if active income is the right word, but it seems like the opposite of passive.
Sure.
So if I'm involved in the day-to-day operation of my company here, that's active income. If you get W-2 income as an employee, that's active income. Like, you traded your time and your efforts for that income. If you owned a business but you didn't have anything to do with operating it, that's passive income.
Mm-hmm.
Everybody seems to want passive income. Well, depreciation only wipes out passive income unless you're a real estate professional. And then it can wipe out all of your income.
Wow. What if your brother is? What if it's in the family?
Yeah, I don't think it works that way, unfortunately.
Yeah, okay. What if you play one on TV?
You would have to check with your friendly neighborhood IRS agent.
That's not happening. Okay, cool.
To be a real estate professional, you have to spend 50% of your time in real estate. So I'm a real estate broker. Like, 100% of my time is spent in that commercial real estate space. Even what we're doing right now is essentially marketing.
Yeah.
For commercial real estate. So I'm a real estate professional. There are some rules. You can Google like how to qualify as a real estate professional. And if you do, you can wipe out all of your income, active and passive, with depreciation. And that is best tax situation I can think of that I've ever heard of.
And it just so happens to work in the line of in the career that you were in.
The career I was almost born into. We ought to do an episode or two on how to actually become a real estate investor. Like, how to do your first deal. Because look, when I got out of the Marine Corps and I started working with Dad, I'm doing deals and I'm earning commissions. And I was making better money than I made in the Marine Corps for sure. And I could see how, I could get into six figures and maybe multiple six figures, who knows. But I looked at what it costs to buy a commercial real estate building. And I'm like, how long is it going to take me to save up the money for a down payment? We were expanding our family at the time. Kids are expensive, it turns out. Like, I had no clue how to do it. Like, you may be sitting there thinking, in your place in Chicago with your two young daughters and your beautiful wife, and thinking, man, I'd love to buy something. Like, how on earth would I pull that off?
Right.
Like, I remember having those thoughts, and there's a number of different ways to pull it off when you're sitting there thinking, I don't have the money to do this.
Right.
Yep.
Right.
So maybe that's some future episodes we could.
Future. Okay. Okay. I was ready for that now. But I think that's a great idea, because that's the biggest question. And for anybody that's not, in the gene pool lottery,
Yeah, right.
it's like it's so easy to be like, Bo was born into it. I'm screwed if this is something I want to do.
I had those thoughts, like, how am I gonna be able to buy my first? I didn't know how to do it either.
Right.
Ended up figuring it out, but you got to buy something like that if you want to take advantage of depreciation, cost segregation, bonus depreciation, all that stuff we've been talking about is just kind of an ideal. That sounds really good.
Mm-hmm.
If you don't own anything yet, there's a lot of people that own commercial real estate and have never heard of a cost segregation study. You can do it at any time. You don't have to do it in the year that you bought it. So if somebody's listening to this and they're thinking, man, I've owned this building for 5 years. Have I missed my chance? The answer is no.
Wow.
You can do a cost segregation study right now and get the benefits that we've been talking about.
What about, how does that affect the percentage on the bonus depreciation every year? How that percentage goes down?
You would want to check with a tax professional here. I think that, let's say you own a building for 5 years, you do the cost segregation study now, and like we're in February of 2023, as we record this, I think you'd be able to bonus depreciate 80% because it was done in 2023.
Okay.
I don't think you'll be able to go back to 2017 or 2018 and get 100% bonus depreciation. I think you would have had to done the study in that year. But I do know for a fact you can do a cost segregation study. They'll do the study, and then the depreciation you've already taken in previous years, that just sort of comes off the top. You don't get that again.
Okay.
But you can accelerate the rest of it based on the study.
So you like really understanding bonus depreciation, what was it, last year or 2022? When did you say?
It was probably the end of 2021. We had bought a strip center in that year. So we put a group of investors together. That's called a syndication deal. We can unpack that at some point in the future. So when we started preparing for our taxes in the spring of 2022, I started to see the benefits, started looking into it a little bit more. And it's like some of the things I'd been hearing at seminars and conferences and stuff started clicking, like, oh, this is what that is. I remember going home to my wife and saying, all year long, I put aside all this money for taxes, and we're not going to need it all. It was, whoa, this is cool.
And the only way to do this is to go into debt. It sounds like.
No. You buy a deal all cash, all of the same stuff applies. If you buy something with all cash, it's probably going to be a smaller property, so there's less to depreciate, right? So debt accelerates everything, but you get to depreciate the bank's dollars just like they were your own.
Thanks for that clarification. But like at the level that we have been talking about.
You either got to have a pile of cash, yeah, or you put a group of investors together that have the cash, or you go get a loan, or you stack those. Sometimes you'll hear investors talk about capital stacks, and what they're talking about is we got a certain amount of dollars from the bank, we got a certain amount of dollars from these investors over here, we put a certain amount of dollars in ourselves. That's kind of their capital stack. They can get a lot more complicated than that, but that's basically what they're talking about. It's where do you access the dollars that you need to buy something? Basically, you borrow it, or you have others invest it as equity partners, or you do it yourself with cash.
How do you find those investors for anybody that is at a point where they got something and all they need is an investor?
Yeah.
Would you know how to answer that?
Well, I can tell you how I did it. And there's level, like I did it the small town way. I've got a buddy of mine who I get to teach with sometimes and does $100 million skyscraper deals. It's essentially the same deal structure. It's just the big boy version of it.
A lot more money. Yeah.
All right. Now, what happens when you sell a piece of property? Because you have to pay tax on the depreciation that you took.
Great.
The government will get theirs.
Are you having fun yet? Bo and I are working very hard to help you live a more fulfilling, happy, successful life. Please subscribe to our channel, hit that notification bell, and ask us any questions you have in the comments. Okay, back to the good shit.
This is kind of the bookend, the end of the story to depreciation, because I've only told you the good parts.
Yeah, that's what I was like, what's the limit? Where's is it too good to be true? Well, I've got all this money setting aside for taxes I don't gotta pay. That's amazing.
Yeah, and that's all true. But when you sell a piece of property, you've heard of capital gains tax. Most people haven't heard of is the cost recovery tax. Here's how it works. You buy a property for $1 million and you sell it 10 years later for $2 million. What's your appreciation there?
$1 million?
You got that right. $1 million of appreciation. Now, let's say over that time, over those 10 years, you've depreciated $500,000. It'd probably be less than that, but we're going to use round numbers. Your tax basis is $1 million when you buy it, and you depreciate it down to $500,000. When you sell the property, you're taxed 25%. So essentially, the government has allowed you to wipe out all those dollars, but for every dollar they've allowed you to wipe out and not pay tax on, they want a quarter back when you sell it. So when you sell a piece of property for $2 million that you paid $1 million for, it has appreciated $1 million. That's the capital gains portion, and I think you pay 20% on that right now. You pay 25% on what you've depreciated. So there's a big taxable event when you sell a piece of property. You got to pay your uncle. So even though it gives you all these incentives and you can wipe out all kinds of income using depreciation, cost segregation study, bonus depreciation and all that, when you sell, he gets paid. Unless you do a 1031 Tax Deferred Exchange, which means you have 45 days to identify replacement properties, and you have to buy those properties, one or multiple of them, within 6 months of the original sale. And if you do that, you can defer all that tax into the next property or properties, and then you just kick the can down the road.
Essentially, it's keeping you from buying something, making a profit by selling it, and that's it. It keeps you, or it incentivizes you to keep going.
The government wants you to keep going. And then eventually, you're going to have to pay that tax unless you die. And if you die, your heirs get what's called a stepped-up basis, and your children can inherit those properties at market value, not at the previous tax basis of their mommy and daddy. And so that's a big strategy that a lot of these commercial real estate investors have, is I'm going to continue to make good deals. I'm going to continue to 1031 into the next deal over and over and over and over again until I pass away. And then my kids will inherit those properties at a stepped up market value where all that capital gains and all that cost recovery vanishes. Pretty good deal.
Right.
When Obama was elected president, he hinted around like he was going to get rid of 1031 exchanges. Commercial real estate industry went bonkers. He didn't do it. Biden did the same thing. Commercial real estate went bonkers. They didn't do it. It would really hurt the industry if the tax 31 or the 1031 tax deferred exchange part of the IRS code went away. All kinds of tax would be due. And I can see why a new president might want to access all those deferred tax dollars.
Sure.
But so far, the commercial real estate industry has been successful in keeping that in there.
This is very interesting stuff, and it makes a few things make more sense.
Like what?
You know, we grow up, Dad's very debt averse, right? That's all I've known. My little, 15-year-old brain, that part that's still there is like, oh, debt, no, that's bad. I'm beginning to understand how debt can be used in this way. So that's number one. Number two, is, just flew away. Just flew away. Where'd it go? And I just unplugged myself from the microphone. Oh, yes. And then number two, it's like politically, you've got red, you got blue. And where I am left leaning, it's mostly because we want to treat everyone as a human being that deserves health care. It makes sense to me to have a base income that comes from the government to make sure that I am able to live eat and take care of my needs as an American or as a human being in America. The right side, right, the capitalistic idea that the American dream, that I can do anything that is possible as long as I put my head down, get out of fucking bed I can believe that, get out of bed and do something with my life. So what makes more sense to me now is when you hear one side being like, what a base income for everybody would do is make more lazy people. And when you've got the other side saying, you were born into privilege, I don't have that opportunity, and I'm struggling living paycheck to paycheck as a single parent, working 3 jobs, and I can barely make ends meet. I guess what my point here, long-winded way of saying it, is there's this huge disconnect between two sides, and those seem to be the main topics I hear. I see where both are coming from. I also see that people who are born into privilege or born just not having to struggle like others can be a huge disadvantage.
Liability. Yeah.
Yeah. There's no appreciation for it. Like understanding, not appreciation as in appreciation, depreciation.
No, I guess.
Understanding some of this tax code and some of this for the first time on this level, it's making sense how there is these two wildly different views. For the majority of people, I think, are doing what they think is best for not just themselves, but for more people in this country.
I would say most people are 100% committed to their own well-being.
Mm-hmm.
And then most after that actually care about others too.
Mm.
But I will tell you this, man, I want to be a force for good in the world and in the community. I want to attract awesome people to this company who can have great success working with us so that they can also do good.
Mm-hmm.
And I'm going to take every advantage that I can to keep every dollar that I can so I can put it to work to those ends.
Yeah.
I don't feel bad about that at all.
Right.
Now, there are certainly people out there that are like, man, I'm just going to hoard it all for me.
Right.
And they could take exactly the same steps as I am for wildly different reasons. Because it's almost never the action of a person, but the motive behind the action that matters.
Like just with our parents, I've seen really loving, caring, giving people.
They're the most generous people I know.
Right. But then you've got others that are not, that just aren't, they're not, and have no interest in it. I can see how the left side to that can put everybody in that box or that bubble. How do we protect the world from people like that who have the power to do it because of the way the laws are written? Anyway, I don't want this to be a political podcast or get into, politics or whatever at all.
Well, look, we're talking about an industry that's regulated by laws that were enacted by politicians.
Right.
It doesn't exist in a vacuum. I mean, that's the context of, how this industry is. All right, so quickie quiz. You, I should say, came up with this idea of doing the pop quiz at the end of the episode after we'd done a couple episodes. So, man, let's go back and tag on some quickie quizzes.
Let's do it.
Okay.
Let's do it.
Question 1, how would you explain the sheltering income nature of commercial real estate?
So I've got income, right? That's coming in, money that I'm making.
Let me shelve that question and ask another one first. That'll set it up.
Okay, great.
All right.
Great.
What is depreciation?
Depreciation is the amount, the life of, let's say, this building here, right?
Mm-hmm.
This building will depreciate over time. It has a certain amount of life cycle, right? Same with the carpet. We're going to have to redo the carpet in like 5-10 years. So it depreciates over time. Where the land that we're on, it's not necessarily depreciating because the land will...
It is not.
It is not. If anything, it's appreciating.
Well, yes. Those things aren't opposites of each other necessarily, but...
Yeah.
Yep.
Okay. So that's depreciation. So it's the life cycle of in this case, the building, the things in the building. And when it comes to taxes, you are able to take a certain life cycle of, let's say, if you do a cost segregation study.
Okay, hold on. Let's keep this. You're answering
did I
this
answer? Okay.
You're answering this at level 10.
Okay.
And I asked you a level 2 question. So, like, just keep it real simple. What is depreciation?
The life cycle, it's the life cycle of the building.
Okay. It is the expense you get to take every year for a period of years when you own a building, because the building will depreciate in value over time.
Okay.
All right.
Yeah.
So just at a very high level, it's an expense that you get to reduce your income by that you don't actually have to pay.
Yeah.
The government allows you to take this expense on your books that reduces your taxable income, but you didn't have to pay that expense.
Right.
So,
Not yet.
well, no, you don't have to pay that expense.
Yeah. Okay.
Later, you'll be taxed on that expense you didn't have. So you don't have to pay it all back.
Yeah.
But you get to pay about 25% of it back later on.
Yeah. Okay.
Now, when you do that, it creates a situation that gets back to my original question that allows you to what?
Shelter
Income.
income.
Yeah, great. Now, who sets the depreciation schedules that you mentioned?
The IRS.
IRS.
Yeah.
That is correct. How many years for depreciation of an office building?
There's more than one answer, right? There's like, no, for an office building, it's 37,
39.
39.
39 years.
Okay.
What about a retail strip center?
20, 15,
39.
39.
Okay, just
Oh, yeah.
a commercial building is depreciated over 39 years.
Yeah.
Okay.
I was thinking of residential, which would be 20, 15 or 20, right?
Apartments, 27 and a half.
Oh, okay.
All right. So, of all the commercial properties, I don't care about houses. We don't do houses. I don't know much about houses other than I live in one. If it's a commercial building, it's 39 years, straight line depreciation. If it's a multifamily property, it's 27 and a half.
Okay.
All right. That's what you depreciate. Now, what is a cost segregation study?
This is where you hire someone like an accountant or an engineer.
Yep.
They come in and they put different things within the building on different life cycles so that you have a more broken down look at what is depreciating so that you can factor in, I guess ultimately leads to bonus depreciation.
That's something different.
Yeah. Okay. But if you do a cost segregation study, you're able to pay off, or not pay off, but take off more income or shelter more income rather when it comes time for taxes.
Is that a question? That's basically correct. Okay. Because here's what happens when you do a cost segregation study. The accountant or the engineer, they come in, they take a look at the ceiling tiles and the carpet, and instead of the whole building being depreciated over a straight line 39 years, they'll say, no, carpet needs to be on a 7-year schedule. I don't know what the schedules are.
Sure.
It's 5, 10, 15-year schedules. And they'll move a lot of the components of the building on these shorter schedules, which means you can depreciate
Faster.
the same amount, but you can do it faster,
Faster, yeah.
which is a benefit. You can shelter more income faster at the beginning of the life cycle of a deal.
Yeah.
And that goes away. So, after 39 years, you've depreciated the same amount. You've just been able, because of a cost segregation study, you've been able to depreciate faster.
Right.
All right. And what is bonus depreciation?
Bonus depreciation is where you're able to depreciate all of it right away.
Okay, I'm going to give you a correct answer on that one, but I'm going to add just a little bit of detail.
Yeah.
Okay. This building that we're in, it's beautiful. This office here at SV in Chicago is really, really cool.
Yeah.
Matter of fact, if I lived in Chicago, I would want to work here. This would be really cool.
Yeah, it's nice.
All right. This building that it's in, though, is bought. It could be depreciated over 39 years. If you do a cost segregation study on it, you can take many of the components of the building, probably millions of dollars of worth of components of the building, and you can depreciate that stuff faster because it's on these 5, 10, and 15-year schedules of depreciation. as opposed to 39 years.
Right.
A bonus depreciation, which in 2023, you can bonus depreciate 80% of what a cost segregation moves from real property, which is that 39-year scheduled, personal property, which is this 5, 10, and 15-year schedule. Instead of depreciating over 5 and 10 and 15 years, bonus depreciation allows you in 2023, 80% of what goes from real property to personal property schedules you can take in that year.
Yeah.
That's a huge chunk.
Yeah.
That might be able to wipe out all your income that year.
Yeah.
You might pay no income tax because of that.
Yeah.
It's a possibility.
Yeah. I mean, you can't depreciate more than what you make,
Correct.
but you can roll it over to the
roll it
next year. Yeah.
Yeah, great. Okay, good. You nailed this one. Awesome.
Sweet.
Good.
On the next episode, which you can watch right here, you are losing investors. You're missing out on a good investment. Bo teaches me about the most misused term in commercial real estate. That term is cap rates. If you have not checked out our YouTube channel or subscribed and turned on the notification, do that now. Bo and I are putting a ton of thought to bring you videos that are entertaining, easy to understand, and that you walk away with new understanding and with a blowed mind. Your mind is. We want to blow your mind. And if you have any questions or topics you want Bo to teach me, let us know in the comments or whatever social media platform you are watching on or podcast platform that you're listening to. We will find it. Please do all the things that podcasts ask you to do, and we will make it. Most importantly, thank you for joining us here at Commercially Speaking. Peace.